Moving on to the next one. What does R represent in the formula? Delta equals X multiplied by R% asterisk T upon 12. Here are your options. A. Risk-free rate. B. Annual rate of interest. C. Inflation rate. Or D. Bond maturity rate. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. In standard interest and accrued interest formulas, R generally represents the annual rate of interest, expressed as a percentage. Test your knowledge with this one. Which type of instrument allows Mr. A to provide a note promising repayment, making it tradable in the market? Here are your options. A. Loan agreement. B. Equity instrument. C. Debt instrument. Or D. Fixed deposit. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. A debt instrument is a securitized financial contract, such as a bond or a promissory note, that represents a promise to repay principal and interest. Unlike a standard loan agreement, it is structured to be tradable in financial markets. Test your knowledge with this one. What is the term for the rate at which a borrower compensates for inflation while quoting interest? Here are your options. A. Real interest rate. B. Nominal interest rate. C. Effective rate. Or D. Reinvestment rate. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. The real interest rate measures the true yield to the lender and the true cost to the borrower, as it represents the interest rate after stripping away the effects of inflation. It reflects the actual purchasing power gained. Let's look at this next question. Which of the following factors would likely increase interest rates during an economic boom? Here are your options. A. Low inflation. B. Excess liquidity. C. High demand for funds. Or D. Declining global rates. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. During an economic boom, businesses and consumers aggressively seek credit for expansion and spending. This high demand for funds outpaces the supply of money, naturally driving up the cost of borrowing, which is the interest rate. Let's tackle this exam question. What action does the central bank typically take when inflation rises? Here are your options. A. Decrease fiscal deficit. B. Tighten money supply. C. Lower policy rates. Or D. Increase bond maturities. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. To combat rising inflation, central banks typically intervene to tighten the money supply. This is often achieved by raising policy rates, like the repo rate in India, which makes borrowing more expensive and cools down excessive spending and price levels. Moving on to the next one. How does high fiscal deficit impact corporate borrowing? Here are your options. A. Increases credit availability. B. Lowers interest rates. C. Constrains funds for corporates. Or D. Reduces inflation risk. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. A high fiscal deficit implies that the government is borrowing heavily from the market. This absorbs a large portion of available liquidity, leaving fewer funds available for private corporates, a phenomenon known as crowding out, and generally drives up their borrowing costs. Test your knowledge with this one. What is the term for the price at which bonds are issued to investors? Here are your options. A. Redemption value. B. Maturity value. C. Issue price. Or D. Par value. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. The issue price is the price at which the issuer initially sells the bonds to investors in the primary market. It can be issued at par, face value, or at a discount. Moving on to the next one. Which of the following bonds has cash flows that vary based on market interest rates? Here are your options. A. Perpetual bonds. B. Zero coupon bonds. C. Fixed rate bonds. Or D. Floating rate bonds. Take a moment to pause the video and decide. The correct answer is option D. Let's see why. Floating rate bonds have a variable coupon rate that is tied to a benchmark interest rate like MIBOR or SOFR. As the benchmark rate moves, the interest payments, cash flows, adjust accordingly. Let's tackle this exam question. What is a bond called when it is issued at a significant discount to its face value? Here are your options. A. Callable bond. B. Deep discount bond. C. Convertible bond. Or D. Inflation indexed bond. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. A deep discount bond, also known as a zero coupon bond, does not pay periodic interest. Instead, it is issued at a steep discount to its face value and is redeemed at par upon maturity, with the difference representing the investor's return. Let's look at this next question. What is the primary risk-free rate instrument in India? Here are your options. A. Corporate bonds. B. Certificates of deposit. C. Treasury bills. Or D. Commercial paper. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Treasury bills, T-bills, and government securities, G-Secs, are issued by the Government of India. Because they carry sovereign backing, they have virtually zero default risk and serve as the benchmark for the risk-free rate in the domestic market. What type of risk arises when a bondholder needs to sell the bond before maturity at an uncertain price? Here are your options. A. Credit risk. B. Reinvestment risk. C. Price risk. Or D. Call risk. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Price risk or market risk is the risk that a bond's market value will decline due to rising interest rates. If an investor must sell the bond prior to maturity, they risk selling it at a lower price than expected, potentially incurring a capital loss. Moving on to the next one. If the nominal interest rate is 6% and is compounded semi-annually, what is the effective annual rate? Here are your options. A. 6.9%. B. 6.0%. C. 6.12%. Or D. 6.25%. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. The formula for the effective annual rate, EAR, is $1 plus R upon N, caret N minus $1. With a nominal rate of 6%, 0.6, compounded semi-annually, N equals 2, the calculation is $1 plus 0.3, caret 2 minus 1 equals 1.609 minus 1 equals $0.609, which translates to 6.9%. What formula approximates the real interest rate for low inflation levels? Here are your options. A. Real rate equals nominal rate times inflation rate. B. Real rate equals nominal rate minus inflation rate. C. Real rate equals nominal rate divided by inflation rate. Or D. Real rate equals nominal rate plus inflation rate. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. According to the Fisher equation, the real interest rate is approximately equal to the nominal interest rate minus the inflation rate. $R approximately equal to I minus pi dollar. This linear approximation works well when inflation rates are relatively low. Which term refers to the price agreed upon to pay to the bondholder at maturity? Here are your options. A. Issue price. B. Face value. C. Redemption value. Or D. Call option price. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. The redemption value or maturity value is the specific amount that the issuer has promised to pay back to the bondholder when the bond reaches its maturity date. This is usually the par value, though some bonds may redeem at a premium. Let's tackle this exam question. What is the purpose of a bond's call option? Here are your options. A. Allows the issuer to repay the bond before maturity. B. Allows the bondholder to demand repayment early. C. Protects the bondholder from inflation. Or D. Ensures fixed interest rates. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. An embedded call option gives the issuer the right, but not the obligation, to redeem the bond and pay back the principal to the investor before the scheduled maturity date. Issuers typically exercise this option when interest rates fall, allowing them to refinance their debt at a lower cost.